Hello again from me, Kevin French at Core Wealth. We're almost at the end of the year, but we're going to cover what has happened so far this year, and in particular what happened in the month of November 2024. So a big story at the beginning of 2024 was that this was the year when the most people ever would go to the polls to elect their leaders. And the biggest election around the world in terms of impact on markets was the US, and Donald Trump and the Republican Party made a clean sweep. Trump moving into the White House early next year, and the Republican Party gaining control of both Congress and the Senate in the United States. The markets loved this. All of the major indices in the US up over 5% just in the month of November. The dollar strengthened on the back of expectations that Trump's policies may be inflationary and therefore interest rates wouldn't come down as quickly. And then one of the sort of bigger main media headlines is that Trump is going to kind of take over as the king of tariffs, slapping tariffs onto, or talk of slapping tariffs onto China to protect against illegal imports into the US, and also tariffs on both Canada and Mexico because of the amount of illegal immigrants getting across the borders. So interesting time ahead. These initial reactions we think are maybe a little bit more exaggerated just in the hype of the results, but we'll see long term how these things start to unfold. So we've seen some improved sentiment towards the Middle East, with Hezbollah and Israel starting to achieve something in their negotiations. On the back of that, we've seen the oil price softer again in November, and it's down over 5% for the year to date. The gold price also softening on the back of some of this, and the expectations of strong economic growth on the back of Trump coming into power. If we have a look at China as another big economy in the world, we've seen the Chinese markets stutter a little bit just on the expectations of potential trade wars between Donald Trump and China, although we think they are actually going to get to a point where they come to some decent solutions. But China's been pumping some stimulus into their economy, and we've seen some improvement from that, and we saw the second month of improvement in their Purchasing Managers Index, or a measure of industrial production in China. And we actually are quite hopeful on some of the movement that we're seeing in China, and a tangible example is BYD, China's biggest electric vehicle manufacturer. Their target for the year was 3.6 million cars, and they've hit that before the end of November, so a month to spare, and they've hit their annual target. So there are things that are really working in China, and we think that some of the momentum that's come through this year will follow into next year, and there could be some good returns from that market. Johannesburg Stock Exchange was down just on 1% for the month. This was on the back of the mining companies struggling quite a lot on the back of softer commodity prices around the world. The place that has really just been the standout return spot to have been in South Africa has been the listed property market, up again just over 1% for the month, but year to date over 20% returns if you were in listed property on the JSE. So the market's not looking great for the last 2 months, but year to date not too bad. Importantly, we've seen on the economic side inflation coming coming through quite nicely, in the sense that it's lower than what was expected. On the back of that, we saw the central bank, or the Reserve Bank, cutting interest rates by 0.25%, and we expect further cuts to come into the future. So have a look at these different returns for the different markets. The big story: developed markets really pushing ahead, almost 7% for the month, on the back of the US rallying after it heard that Trump was coming into power in 2025. Emerging markets over 10-15 years looking a lot better, but still almost half what developed markets achieved over that period. However, looking forward, as we said, we think the opportunities in emerging markets look very attractive. So this is the South African financial markets. You can see the JSE down over the last month, and actually this is the second month in a row that it's been down. But if we have a look over the last year, the All Share Index up 16%. That's a really credible return and a healthy creator of wealth for investors. But the place to have been was definitely listed property, up over 28% year to date, over 41% over the last year. But if we have a look at the longer term numbers, the 5-year numbers now for equities, around 13%. Even our bond market over the last 5 years has been very strong at some 10%, stronger than you would expect in the longer run. So we're starting to see the 5-year numbers in clients' portfolios really picking up quite nicely as we're seeing our markets starting to perform better. So here is our global strategy in sterling terms, and you can see a lot of green on that graph. Remember, green shows that we've outperformed our peer groups, red shows there's underperformance, and just the global strategy, the growth strategy, I beg your pardon, that underperformed peers slightly. But even with that underperformance, we've still generated a 16.1% return over the last year in sterling terms, in hard currency. But importantly, since inception, which is now over 3 years, some good outperformance of peers in all of our strategies that we are running globally in the sterling section. This next slide shows the same global strategies, but those that are run with on a US dollar basis, so thinking of the world in US dollars. And again, some really good outperformance. These models have been running now for over 8 years, and we can see since inception around 1% every year that we've outperformed the peer groups, which is really pleasing to see, and a means of generating really good outperformance for clients in their global strategies. So here we have a look at our Rand denominated models. And again, a lot of green, fortunately, showing consistent outperformance of peer groups. And the 1-year number looking quite attractive in terms of wealth generation for clients. If you think that a long-term strategy, something like our retirement growth strategy, 1.3% ahead of peer groups, and over 16% return for the clients. So your wealth really growing quite nicely in the last 12 months. But then look a little bit further to the right and you can see these longer term strategies over both 3 and 5 years, strong double-digit returns, and again healthily ahead of the peer groups, especially over the 5-year the 5-year period. Then lastly, since inception, all of the strategies generating outperformance over the class average, and something we're quite happy to see. So we're going to conclude this video by just looking at a couple of graphs that try and summarize big things that happened in 2024. The first one is looking at inflation, and here we can see the mustard colored dots just show the level at which inflation peaked in each of those different countries, and the blue bars just show what the latest inflation number is, and we can see all of them significantly below their peaks. And even though some of those peaks were really extreme, if you have a look, even the US, the UK, the Eurozone, really high numbers compared to their history, but now these inflation numbers are back at a reasonable level. And importantly, this takes pressure off interest rates, so interest rates can be dropped, which should be good for economic growth in future. So this next graph just has a look at interest rates in the US in particular, and we can see the blue line is where interest rates moved, and you can see there in 2022 how sharply interest rates were pushed up in the US as they were trying to make sure inflation came under control. We've seen that now roll over and they've started reducing interest rates, but then the green line just shows what the market is expecting to happen in future, and the market is not expecting material cuts in interest rates compared to history anyway. However, the committee that decides on how interest rates are changed in the US is expecting, and that's the orangey colored line, that is, they are expecting to see interest rates come down even further. And again, either perhaps we end up somewhere between the two, but the point is that interest rates are still on their way down and will come off of that peak quite considerably. So this slide has a nice summary, or gives a nice summary, of how expensive shares are around the world and what growth rates you're expecting in the different countries. So you can see if we have a look at China on the very bottom there, expecting earnings to grow at around just over 19% a year. So really strong growth rates expected there. But if we look at price earnings ratios, I know they have their limitations, but just as an indication of how cheap or expensive a market is, China is really at the low end of their history. So the candlestick really is looking at the history, the most expensive they've ever been and the cheapest they've ever been. The little diamond shows where they are now looking at earnings in a year's time, and the 10-year average is the black square. So looking cheaper than their history, looking cheaper than their long-term average, and therefore Chinese, with some very good growth rates expected, so Chinese equities looking very attractive. European equities, a similar picture, but not quite as attractive from a growth point of view, but cheaper than their longer-term histories. Japan is now sort of at neutral levels after for a very long time being cheap, and then the United States and India, although they've got some very attractive growth rates coming out there, very expensive versus their history, and something that one has to temper, we believe, exposure to the US because of that, and find companies that have good growth rates but are also maybe a little bit more attractive from a valuation point of view. So this next slide has a look at the S&P 500, one of the big stock markets in the US, also has a number of the tech companies in there, and looks at, since 1999, the best year, the worst year, and the current year. So the worst year was the red line, as you'd imagine. That was 2008, when we had the global financial crisis, and the line going down quite significantly, losing about 40% of its value in that year. The green line is the best year, and that was in 2013 actually, and the market going up just over 31% in that year. The blue line is the current year, and we can see that this graph is showing up to the end of November, up almost 28% for the year, and we still have a month to go. So this could end up being the best year ever since in this century. But on the right, what we are showing, and we're just looking at valuations on the S&P every quarter, that has continued to get more and more expensive. In other words, price return, the share price return has been going up faster than those companies are improving their earnings. So why do we go on about shares being expensive? Well, this graph tries to summarize that. I know it might look a little bit technical, but actually it's quite easy to understand at the end. Along the bottom, we've got the price earnings ratio. So the further you are to the right, the more expensive or the higher that price earnings ratio is. And then the vertical axis measures the subsequent 10-year total return from that point in time. So if you look at the red dot that we've shown in the graph in the bottom right hand corner, that's the current valuation or the current price earnings ratio on the S&P 500. Historically, other shares or other periods when the market was at that level of expensiveness, the following 10 years worth of returns were actually basically flat or even slightly negative. History shows us that when you're able to buy the S&P 500 at much cheaper levels, i.e. the dots being further to the left, the subsequent 10-year returns are way better, in the teens in terms of returns per annum over the next 10-year period. So these levels of expensiveness really do concern us. So we've just been speaking about the S&P 500, but what about other markets around the world? And this graph is some research from a company called Research Affiliates in the US, and it just shows along the bottom we've now got volatility, so how up and down the returns from a market are, and on the left hand side is the expected future returns over the next 10 years in US dollars, but above inflation. And so essentially you want to be on the vertical axis higher towards the top, and on the horizontal axis it's just showing you how volatile those returns are. So as we can see here, we were just talking about the US, expected future returns very low, only just somewhere around 1% per annum over the next 10 years, above inflation however, 1% above inflation, and sort of middle of the pack in terms of volatility. So but there are other areas where the expected returns are much higher. A lot of them are emerging market countries like China, South Africa, and then emerging markets as a whole. And then some of the more developed markets like Japan, the UK and Australia also looking very attractive. The emerging markets generally more volatile, but if you're going to be rewarded with those kind of returns, we think it's something that is worth considering in the portfolio. US bonds, the outlook for US bonds is actually better than the equity markets over the next 10 years and at a lower level of risk. And then emerging market bonds, something we've held in our portfolios on the global side for a while now, also looking quite attractive as we look forward. And really what we're trying to do is put these different markets together in our portfolios, or getting exposure in our clients' portfolios, to make sure that we get a good long-term outcome. So while there's been some interesting things happening this year, especially with the noise around elections and then the turmoil in the Middle East and the Russia-Ukraine crises, on the whole, it's actually been a good year for financial markets, and we think the outlook continues to improve actually. And so from our side, we want to thank you for the opportunity to work with you and to advise you. We do appreciate your business. Those of you who celebrate Christmas, I hope it's a blessed one for you and your families. And those who are just taking a break, enjoy the break, and we look forward to seeing you in 2025.